This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. This is Professor Russell James at Texas Tech University. Welcome to Charitable Remainder Trust Part 4, Taxing Distributions. We have considered the charitable income tax deduction generated for the donor transferring funds to a charitable remainder trust, and the tax treatment of gains recognized or income earned by the trust itself in previous lectures. There is one additional source of tax consequences for transfers to a charitable remainder trust. This comes from the payments made from the charitable remainder trust to the annuitant or annuitants. When an annuitant receives a payment from the charitable remainder trust, how should the annuitant report that payment on his or her taxes? The tax treatment of payments coming to an annuitant depends in part on the tax characteristics of the money held by the charitable remainder trust. The trust may be holding a variety of asset types, including ordinary income, capital gain, exempt income, and initial principal. For example, the basis in property initially transferred to the trust. So when a trust is holding all of these types of assets, how do we determine which asset type the annuitant receives? The fundamental rule is referred to as worst in, first out, or WIFO. In other words, the annuitant receives the asset type that would normally generate the highest tax rates first. Assets with lower tax rates will be distributed only after there are no remaining assets with normally higher tax rates. An easy way to visualize this rule is to think of the charitable remainder trust assets as liquid inside a water cooler, where the assets with the heaviest taxation are on the bottom, and those with the lighter taxation at progressively higher levels. When a payment is made from the trust, it's like opening the spigot at the bottom of the water cooler. The liquid with the heaviest taxation comes out first, and those with lighter taxation will come out only after those assets with heavier taxation have been completely drained. For example, all ordinary income will be paid out before any capital gain income. All capital gain income will be paid out before any tax-exempt income. And distributions of tax-free return of principal will occur only when there are no other types of assets to distribute. Let's consider an example to demonstrate how the WIFO, worst in, first out, rule works. Suppose a donor gives $100,000 of stock, which she initially purchased for $10,000, to a charitable remainder trust. After receiving the stock, the charitable remainder trust trustee sells the stock for $100,000 and buys corporate and municipal bonds. During the first year of the trust, the corporate bonds generate $3,000 of income, and the municipal bonds generate $2,000 of income. Assuming that the charitable remainder trust makes annual payments, what type of assets will be included in the trust at the end of the first year when the first payment is about to be made? The donor's $10,000 basis is included in the trust as an asset that could be paid to the annuitant as tax-free return of investment. At the next level, the trust has earned $2,000 of tax-exempt income from its investments in municipal bonds. Next, the trust has $90,000 in capital gains from the sale of stock for $100,000, because the stock was purchased by the donor for $10,000. Finally, at the lowest level, the trust has $3,000 of ordinary income earned from the corporate bond investments. The trust itself is a tax-exempt entity. Thus, the trust pays no taxes on any capital gain or income earned. However, if capital gain or ordinary income is distributed to an annuitant, then the annuitant will be taxed on that distribution based on the type of income or gain being distributed. Suppose the charitable remainder trust were required to pay $2,000 to the annuitant. How would the annuitant report this $2,000 payment on her taxes? In this case, the trust is holding $3,000 of ordinary income earned from its investments in corporate bonds. Because all ordinary income must be paid out prior to the payment of other types of income, the entire $2,000 payment will count as ordinary income to the annuitant. Suppose instead the charitable remainder trust were required to distribute $5,000 to the annuitant. How would the annuitant report this $5,000 on her tax return? Because the trust is holding $3,000 of ordinary income, that is, earnings from the interest payments on corporate bonds, this amount must be paid out first. The remaining $2,000 would be paid from the $90,000 of capital gain held by the trust. The ordinary income is paid first because it normally receives the worst tax treatment. In other words, it generates the highest tax rates for the typical taxpayer. The capital gain is paid next because it is worse than either exempt income from the municipal bonds or tax-free return of investment from the donor's basis in the gifted property. The WIFO concept, worst in, first out, dictates that all capital gain must be paid out before any payments are made from the exempt income or original basis. Thus, the distributions to annuitants would have to completely pay out all $90,000 of capital gain income to the annuitant before the annuitant could receive any form of exempt income or tax-free return of basis. It likely would make no sense for this particular charitable remainder trust to invest in municipal bonds. The tax-exempt nature of municipal bonds does not affect the charitable remainder trust itself because the charitable remainder trust is a tax-exempt entity and pays no tax on income earned. The tax-exempt nature of municipal bonds could benefit the annuitant if this tax-exempt income were paid to the annuitant, but such payments are highly unlikely given the relatively large amount of capital gain yet to be distributed. There are, of course, other more detailed distinctions in income type than those presented in this example. However, where the tax treatment of assets differs, the general WIFO rule still applies. Thus, investment income recognized prior to December 31st, 2012, and thus not subject to the 3.8% healthcare surtax, would be paid out only after similar income earned after 2012. Similarly, a capital gain recognized after 2012 and subject to the additional tax would be paid out prior to any capital gain recognized in 2012 or earlier. This tax treatment of distributions from charitable remainder trusts means that capital gains taxes deferred through the use of charitable remainder trust may never be paid. If the trust's total ordinary income earnings are greater than its distributions, then no capital gains payments will ever be made. In this way, the capital gains tax deferral can very often be complete capital gains tax avoidance. In contrast, a charitable gift annuity purchased with appreciated property can defer recognition of the capital gain, but will not avoid the tax. Conceptually, this could be phrased as a benefit of the charitable remainder trust because the trust offers not just capital gains tax deferral, but actual capital gains tax avoidance. But in reality, the charitable remainder trust annuitant avoids the capital gains tax only by paying the higher ordinary income tax. As compared with purchasing a charitable gift annuity with appreciated property, the advantage of capital gains tax avoidance means paying higher ordinary income tax and never receiving tax-free return of investment. This has been Charitable Remainder Trusts, Part 4, Taxing Distributions by Professor Russell James at Texas Tech University. Join us for the next lecture, Charitable Remainder Trusts, Section 5, Special Trust Types.